Welcome to your market brief for the week of February 18th. I'm Caroline Woods. As coronavirus fears continue to grip markets, Chris Harvey, head of equity strategy at Wells Fargo Securities, is here with your playbook for the coming week. Chris, thanks so much for being back with us.
Thank you.
All right, so I want to start with Apple. It just warned that Q2 revenue will fall short of guidance due to coronavirus. Is this just the beginning of the fallout? How concerned are you about this?
Well, we're pretty concerned, and really it's not the direct effect, but it's the indirect effect. And we saw this with trade and tariff. Once trade and tariff really started to move, the C-suite realized that I have counterparty risk with China. We had phase one done, and I think people got optimistic. But now what they're realizing is, I really do have more counterparty risk than I appreciated, and I've been underappreciating diversification and other issues. So I think the bigger issue is that supply chain still has to be disintermediated out of China at the margin, and that's going to have big economic effects. And so I don't think this is a very small issue. I think we'll continue to see the ripples from coronavirus for some time.
So it's not a very small issue, but how does it impact your forecast? Because last time you came on at the end of December and you said you liked the market, you didn't love it, and that was before coronavirus was in the picture.
That's right, and hopefully we said this at that point in time. We said that we're expecting volatility to become more volatile. We're expecting more spikes in volatility, and this is going to cause it. We expect, with expectations much higher than they've been, with optimism so positive, to see a lot more pullbacks. We do think you're going to see a 5 to 10% pullback in the first half of this year, but really we expect to see more volatility with volatility, and this is the beginning of something that we thought we'd see a few months ago.
But then taking a look at your price target, 33.88 for the S&P 500, that's actually the same as it was in December when you were on, so not too far from where we are now.
No, not very far. Not very far at all. So we like the market. We don't love the market. Can the market go higher? It can, but if you think about it, last year at this time, we came in very conservative. We knew that we were going to raise expectations because we thought the Fed had made a mistake. We're not thinking along those lines this year. The other thing is, if you look at the small caps, you look at mid caps, they're up 1-2%. A lot of the uber caps are driving the broader market, driving the S&P 500. 5 stocks account for half the return. And so that's difficult to really appreciate or to really handicap. So we like it, we don't love it though.
All right, so let's talk about portfolio positioning. Where are you seeing opportunities and what are you steering clear from?
So one of the things that we've done over the last 12, 18 months is said, add cyclicality to the portfolio, add risk to the portfolio. We're slowly starting to take some profit. We're slowly starting to harvest that. So back in December, we downgraded semis. Now what we recently did is we upgraded the insurance sector. It's more defensive, there's good valuations, and surprisingly, it has a positive story when it comes to China. With China, you're starting to open up to other financial companies. They have a small foothold there, and we think that can be a real positive for the group.
But then downgraded household products.
Right, so we don't want to pay up for defensive properties. In addition, the household goods does have that coronavirus risk, and we just really don't want to play that, especially at those valuations.
So you're expecting a lot of volatility this year. Obviously 33.88 is higher than we are right now, but so does the path of least resistance is what?
The path of least resistance until a few weeks ago was up, right? So in the first 2 weeks of the year, you were annualizing a 75% return on the S&P 500. As of Friday, you were annualizing a 50% return. And so we've seen the market grind higher. I'm not so sure we'll continue to see that, because what we believe is, one, you're starting to see the effects of coronavirus. Two, what you're beginning to see is that people are realizing the Fed, or the Fed's heavy lifting, is over, so that accommodation isn't there. And two, that this is going to be a lot more difficult market because expectations were good, but not great.
But do you think the fundamentals right now, obviously also we just had Apple warning, we had Walmart miss this morning. Do the fundamentals support current levels?
So we look at it two ways. The fundamentals, again, getting back to mid and small caps, the returns were 1 to 2%, and I think that's a pretty good proxy for the fundamentals. The fundamentals are okay. When you look at the large cap, a number of large cap stocks, and now you're right, Apple has pre-announced, but until now, some of the uber caps, the fundamentals were actually even better than you were down the capitalization. Overall, I think the fundamentals are okay, but I think expectations have come too far. Optimism is a little bit too much, and I think people are underappreciating a lot of risk in the marketplace.
We have to leave it there. Chris, thanks so much for joining us.
Thank
we really
you.
appreciate your insights. Shifting to a quick look at the week ahead on the campaign trail, the next round of Democratic debates gets underway Tuesday night in Las Vegas. The Nevada Democratic caucuses then begin on Saturday. During this holiday-shortened week, we'll get minutes from the Fed's January meeting. We'll also get a read on U.S. production with the release of the January PPI, plus data on the health of the U.S. real estate market. On the earnings calendar, Analog Devices and Dish Networks reports on Wednesday, plus Newmont, Norwegian Cruise Lines, and Viacom CBS report on Thursday, and then Deere comes on Friday. We'll keep a close eye on what Norwegian leadership says on the call regarding service interruptions. The company recently canceled a trip that was slated to leave from Singapore as a result of ongoing coronavirus concerns. Now shifting to the world of crypto, as Bitcoin hovers near $10,000, one of the digital currency's biggest bulls says there's a lot more room to run. Tom Lee is head of research for Fundstrat Global Advisors and is here with his outlook. Hey there, Tom. Great to have you on.
Thanks for having me.
All right, so I want to clarify your forecast because you recently made headlines for saying that Bitcoin will reach 40,000 before the Dow. You stand behind that forecast, and what makes you so bullish?
Well, Bitcoin, yes, and so that's absolutely our belief. Bitcoin's a network value asset, so the more people who hold it and find it useful, the greater its price gain. It's really a log function. Today, about 500,000 people use Bitcoin, so for it to quadruple, you just need to double the number of users.
Okay, so what's your response then to some of these parabolic bulls? Because you're pretty bullish, 40,000 before the Dow, which is quite a bit higher than where it is right now. But some of these parabolic bulls have estimates as high as $500,000, $250,000. What's your response to them?
I think in the long term, it's possible because today Bitcoin's transaction activity is twice that of PayPal, 7 times Discover Network. It's the second largest transaction network after Visa. And there's 4 billion Visa cardholders. So if you get to 5 million Bitcoin users, it's almost 100x increase in price.
Okay, so what would the timeline on a $500,000 for Bitcoin be?
I don't know. I think
No
if there's
crystal ball?
no crystal ball.
Okay, so we have the bulls like you, we have the parabolic bulls, and then we have, on the other end of the spectrum, we have people like Minneapolis Fed President Neil Kashkari. In his latest Streetwise column, Jack Howe called him a total Bitcoin buzzkill because he said cryptocurrencies were like a giant garbage dumpster. Why is he wrong?
Well, I think that the current monetary system works quite well. So it's not like I'm necessarily critical of how financial systems work, but too much money is paid to intermediaries. Today, roughly 6% of all GDP globally is paid to the financial system to manage trust. Bitcoin's been around for 11 years, has never had a single fraudulent activity on its blockchain, $5 trillion of activity. So it works better than the traditional financial system, and the cost is vastly lower. Today, you can transmit $1 million of Bitcoin between countries for $15. That same transaction using remittance counterparties would cost you 5 to 10% of that, so 50 to 100,000.
So what derails your forecast then? In which case are you wrong and Bitcoin is garbage after all?
Well, the future's uncertain. And Bitcoin would be destroyed if there was some sort of proof of work attack on its blockchain. So if somehow the blockchain became insecure, it would lose all of its value. Governments could try to ban the off-ramping of Bitcoin. So to convert it back into fiat, they could tax it or make it illegal. That would make it very difficult. So there's a lot of ways to kill Bitcoin, but look, it's a generational thing. A lot of young people, look at Schwab's latest holdings for stocks. Like a top 5 holding is the Grayscale Bitcoin Investment Trust. Young people, just like young people adopted the internet, young people are adopting cryptocurrencies.
We were just talking about the impact of coronavirus on the stock market. How does it impact Bitcoin?
This is good for Bitcoin because it's creating a asynchronous or idiosyncratic event that makes Bitcoin more useful. China is trying to contain its market. People want to move money freely. There's geopolitical tensions. Makes Bitcoin more useful. But the coronavirus, I think, is ultimately a non-issue globally.
All right, we'll leave it there. Thanks so much for joining us, Tom. Lastly, you voted on the best investment strategy right now amid record market highs, buy, hold, or sell. The results are in, and a third of you are holding your current equity positions. However, in a close second, a fourth of you are buying more U.S. stocks. That concludes today's Market Brief. However, we want to hear from you. Comment below and tell us where a $10,000 investment would net you the biggest gains in 10 years. Buying shares of Tesla, Bitcoin, U.S. 10-year treasuries, or gold. I'm Caroline Woods. Thanks so much for watching.